Hey there, investors. Strap in, because I've got some news that might make your portfolio do a double take. Alright, so you know that comfy, cozy feeling you get from parking your cash and treasury bills? Yeah, that T-bill and chill vibe? Well, according to JPMorgan, it's time to grab a blanket because that chill is about to warm up. And not in a good way. Here's the deal. Treasury bills have been yielding a sweet 5% since 2022 thanks to the Fed's tight policies. But as we look ahead, JPMorgan's crystal ball shows those yields dropping to around 3.5% over the next 18 months. And if the economy takes a nosedive, they could drop even faster. Ouch. Now I know what you're thinking, but I just moved a ton of cash into money market funds. What now? Don't worry, you're not alone. In August alone, these funds saw a massive inflow of $106 billion, pushing total assets to a record $6.24 trillion. That's trillion with a T. But here's where it gets interesting. JPMorgan is advising you to ditch the short-term treasuries and start thinking long-term. Picture this, long-dated bonds and large-cap equities. Sounds fancy, right? But here's why. Historically, T-bills underperform when interest rates decline. And with the Fed likely to cut rates, you might be missing out on some juicier opportunities. JPMorgan points out that core bond yields are still looking attractive at 4.4%, but that window is closing fast. For example, 2-year yields have already dropped 85 basis points in less than 2 months. So, it's time to act sooner rather than later. Alright, let's break it down. If the Fed cuts rates due to a recession, JPMorgan suggests cozying up to US large-cap and growth stocks, while being cautious with international equities, value stocks, and small-cap stocks. In fixed-income investment-grade bonds, especially those with long durations, are your new best friends. High-yield bonds? Not so much. But, if the Fed pulls off a miraculous soft landing with low inflation and no severe downturn, stick with large-cap stocks. U.S. growth and value equities are expected to perform similarly, and risk assets and high-yield bonds could actually give you some decent returns. So what's the takeaway here? It's all about understanding the economic landscape and aligning your portfolio accordingly. Whether it's a recession or a soft landing, having a dynamic investment approach is key. And hey, don't forget to hit that like button if you found this info helpful. Subscribe for more updates and investment tips. Thanks for watching and happy investing.